Hi guys, and welcome to our podcast. Today we're going to discuss about the most popular REITs for investment and what's the difference between them. The real estate industry is one of the most profitable business ventures. While most people understand real estate from a point of investing in houses, see 2017 top trends, there are various other aspects of the same that are just as profitable. Simply put, REIT is an avenue for investing in real estate without actually owning rental properties. The main method of investing in these trusts is either by owning properties directly or investing in mortgages and other mortgage-related securities. REITs are available in a number of sectors including healthcare and retail industries, among others. Thus, the best way of investing in REITs is by trading across various sectors. REIT investment has many different kinds that can be relevant for almost any investor. The main method of investing in these trusts is by either owning properties directly or investing in mortgages and other mortgage-related securities. REITs are available in a number of sectors including healthcare and retail industries, among many others. Thus, the best way of investing in REITs is by trading across various sectors. This way, the probability of profitability is increased. There isn't much of variety on offer when it comes to the exchange-funded funds, JRM in 2014. There are roughly over 200 REITs trading on the U.S. exchanges, but there are other various ways in which one can divide the sector and put it in some unique packages. Some of the funds invest only in the most feasible REITs, while others invest broadly in REITs. Of course, exhaustively, every REIT fund cannot be analyzed, but below is a complete analysis of some of the best funds. The first option is to invest in Vanguard REIT ETF. This is the industry's leader in terms of assets with a comparatively cheaper estate trust fund. The best thing is that it's the investor who enjoys the attractive dividends given that the average expense ratio stands at 0.12%. The case for the above REIT is very simple. The main investment platform is the equity REITs and has a bias for larger issuers. It does not avoid other forms of hybrid, thus this can be summed up as a large cap REIT ETF. It does not avoid other forms of hybrid REITs which own property and other alternative assets like mortgages. As of April 30th, 2016 statistics, the fund held positions in 150 different REITs. These REITs were further diversified according to the properties they held. However, retail REITs make up the largest percentage, taking up to 24% of the entire fund. Among conservative investors who like to have an extra yield while at the same time avoiding the risk of highest yielding mortgage and hybrid REITs, which are riskier, this fund is the best alternative. Omega Healthcare Investors Incorporated, OHI, is another great opportunity. The above is an REIT which invests in healthcare facilities with particular emphasis on the long-term prospective facilities. The main countries are the United States and the United Kingdom, which tend to have stable healthcare facilities. It provides lease or mortgage financing to operators of skilled nursing facilities, SNFs, assisting living facilities, ALFs, independent living facilities, ILFs, and rehabilitation and acute care facilities. As of December 31st, 2015 statistics, the company's investment base boasted of 949 healthcare facilities located in both the U.S. and the U.K., but which were operated by 83 third-party operators. These third-party operators comprised of 782 SNFs, 85 ALFs, 16 specialty facilities, and 1 medical office building. They had fixed-rate mortgages of 56 SNFs and 2 ALFs. The third REIT is SPDR Dow Jones ETF, RWR. The RWR is the U.S. REIT ETF with a broad base. However, the price of one is a little higher in comparison to some of the top stock holdings. SPG makes up nearly 10% of the total fund, with public storage just a little more than 5% of equity residential and PLD, each taking up roughly over 3%. In this case, the industrial office-focused trusts enjoyed about 25% exposure, retail enjoys 20%, while residential has about 20% exposure. The fund has about 96 holdings in its entire investment platform. The fund is more inclined towards residential REIT since 17% of the total holdings are concentrated in apartment buildings. Regional malls are up next with a 15% allocation, while healthcare takes up 11%. There's no single REIT that represents more than 10% of the total assets. RWR has an excellent track record for achieving about 11% annual returns since its 2001 inception. Another nice investment is Five Oaks Investment Corp, OAKS. This is an REIT focused on investing in financing and managing residential mortgage-backed securities and, by extension, all mortgage-related investments. This firm is managed by Oak Circle Capital Partners, LLC, which is an asset management firm based in the United States. The main source of capital for this REIT is the mortgages due to the heavy investment on mortgage-related investments. iShares is among the popular REITs in the market we can find. iShares Global REIT ETF, REET. U.S. REITs make up about 63% of this fund. The rest of the REET's geography weight is in developed markets, with Japan and Australia weighing in with at least 7% and the UK at 6%. The only internationals holding top spots are France's Unibail Rodamco and Centre Group. Apart from the Vanguard REIT discussed earlier, this REIT is the best platform for the investors seeking foreign exposure to a multinational level. We also can find iShares U.S. RE ETF, IYR. This REIT has a low exposure ratio of about 0.43%, which is significantly higher compared to VNQ. However, it's more concentrated with 117 holdings in its portfolio. It's characterized by higher weighting towards specialized REITs and considerably low exposure to industrial REITs, hotels, and mortgage REITs. It has a higher dividend yield with a trailing 12-month yield of about 4.1%. This figure is more than twice that of the S&P 500 average dividend, which stands at 2%. The higher total yield for the fund is generated by the higher yield REITs in its portfolio. Additionally, it is also less volatile than the broader equity market with a beta value of 0.95, which means that for every 1% move in the S&P 500, it will move 0.95%, which is a significant margin for safety. Schwab U.S REIT ETF, considered among the best REITs available. It is the cheapest REIT ETF on the market. The annual expense ratio is about 0.07% of the total fund assets. It uses the performance of the Dow Jones U.S Select REIT Index, which includes the equity REITs. Holding just 106 REITs, it's the most concentrated ETF. It has a weighted market cap, which implies there is a bias towards large cap REITs. Only 10 companies contribute to a massive 41.1% of the overall fund assets. The largest holding, Simon Property Group, holds about 9.1% of the total fund assets. This fund has the lowest yield, which stands at a mere 2.6%, due to the fact that there is more focus on market capitalization rather than investor returns. Despite the low yields, the fund's 5-year total return is almost equal to Vanguard's returns, but is higher than the iShares fund performance. Another option is to go international. Markets outside the U.S. have considerable growth prospects. The most prospective markets are those within the emerging markets and those in the early stages of economic recovery. To supplement the Vanguard REIT ETF exposure mentioned earlier, Vanguard offers the Vanguard Global ex-U.S Real Estate ETF. This has a sum total of $2 billion in assets with an average yield of 3.5%. The expense ratio is a paltry 0.27%, which is a considerable figure due to the fact that international funds are more costly compared to the domestic funds. Given the above statistics, this REIT is a good prospect for those willing to invest in markets outside the United States. Conclusion. The above represents some of the best REIT funds available in the market. As mentioned at the very beginning, REITs are simply aimed towards investing in real estate without actually owning properties. The odds for each fund has been analyzed, and the intention is to enable possible REIT investors to make the best decisions based on facts. Additionally, the decisions can be based on the preferred economic sector and the preferred country for investment. All in all, REIT is a feasible alternative to real estate ownership. That's it for now. On our website you can find more posts as well as investment calculators and other financial tools. I hope you enjoy, and don't forget to subscribe to our podcast channel on YouTube. We would love to know your REITs, so feel free to share them in the comments below.